Hello and welcome back to Principles of Macroeconomics. I'm your host, Dr. B, and today we're going to talk about savings, investment, and the financial system. So, earlier I had said it's so important to save and invest. I say that all the time because when you save and invest, you are making investments into your future. How do you make investments into your future? You save money in your 401k, in your 403b, in your IRA, your Roth, whatever. Uh, those are all retirement savings accounts. Those retirement savings accounts are investments into your future. How is that? Those retirement savings accounts are a mix of stocks, bonds, etc., which are a combination with saving that grows over time, and that ultimately pays you out an interest rate, so to speak. So let's look at the financial system as a whole. The financial system here in the United States, we have a couple of things. We have what we call the Fed. The Fed is the federal what do you call this? It's a central bank. Yeah, it's the Fed. And within the Fed, we have individual institutions. We have uh, we have the Fed in New York. We got the Fed in Chicago. We got the Fed in somewhere else. There's a couple of them, right? And so these individual institutions make up the economy with respect to savings and investment. That's the Fed. That's the system. Okay. And the Fed provides support and cash to banks. And the banks are the financial institutions. And these banks are used by individuals that save and borrow funds for various reasons. Individuals and, of course, businesses do the same, right? And those banks provide opportunities for investment. In addition to the banks, we also have the financial markets. This is the securities exchanges like the NYSE, the NASDAQ, the Dow Jones Industrial, et cetera, et cetera. Those are financial markets. Financial markets are where stocks and bonds are traded openly on the market, the exchanges, right? Then we also have what we call financial intermediaries. Intermediaries, think of them as like the middleman of finance. They are the brokers, the stockbrokers. So the markets, you got your banks, you got stocks and bonds. Bonds are certificates of indebtedness between an individual and a debtor. For example, oftentimes a business will issue bonds to individuals to be held. Okay, and so with that bond, it provides a way where the bondholder has access to equity of the business, and they are due from the business. An example of a bond would be I currently hold a 90-day bond for Macy's. Macy's will pay me the face value plus interest, uh, and the bond is the form that's the loan agreement essentially. That's what the bond is. Yeah? Think of it like a short-term loan, basically. uh, the stocks are a form of ownership in a company. A lot of you have stocks, whether you know it or not. They're typically within your retirement funds. Stocks are a form of ownership into a company, and they're bought and sold on the open exchanges. Institutions where individuals save indirectly in funds and borrowers, we call as banks. uh, there's also this one called mutual funds. A mutual fund is is Fidelity. It's Schwab. It's those types of uh, um, institutions that sell shares of stock uh, and bonds. Ameritrade. List goes on, right? A whole bunch of them. So, for those of you who recall this, which is probably all of you, 2007 was kind of a rough year. What happened in 2007, 2008? We almost had a stock market crash. Why did that happen? There was too much investment that banks made into real estate. They were issuing mortgages at subprime rates that people couldn't afford. They did it anyway. Ultimately, too many people started defaulting on their mortgages, and it caused a recession. This happened, it wasn't just the United States, it happened around the world. But the US was the greatest impacted because a lot of the loans were made here. What happened? 30% of the housing almost defaulted, came close to defaulting. Financial institutions didn't have enough cash on hand. People couldn't pay back their mortgages. There was a declining confidence in financial institutions. So the banks failed, right? They just didn't. So what happens when a bank fails? Let's say we all bank at the same bank. We're all at Bank of America, okay? And let's say Bank of America announces that they're having trouble paying loans. What happens with that? I don't want to bank with them anymore. But neither do all of you. So we all run to the bank and pull out our cash. That'll cause the bank to fail. So during this time, 2008, 2009, 2007, we had what we call a credit crunch. No one could get a loan during that time. It was very difficult because the lenders didn't have enough cash and the borrowers didn't trust the lenders and the lenders didn't trust the borrowers. There's a large economic downturn. Unemployment went sky high. And it created what we call a vicious cycle. There's this drastic downturn. Asset values worsened. It was just overall a very bad time to be an investor. So we talked about gross domestic product. We're going to keep talking about it because the gross domestic product really is the crux of not only this course, but how the economy works as a whole. Gross domestic product is consumption plus investment plus government purchases plus net exports. You all remember this, right? We've talked about this a couple times. Consumption plus investments plus government exports. If our net exports are zero, then we can say that our gross domestic product is consumption plus investments plus government spending. So our investment would be gross domestic product minus consumption minus government spending. It's kind of like solving for X, right? That's basically all we're doing. We're just solving for X. So if X is, what is our income? Well, we can figure out income if net exports is zero. Our income is, of course, going to be our gross domestic product minus consumption minus government spending. But now let's introduce national savings. We can determine how much the nation is saving based off of the idea that we take gross domestic product minus consumer spending minus government spending. The difference, of course, is savings. If you're not spending it, you're saving it, right? That's obvious. If I give you $1, okay? And I say you do what you want with that dollar. You can either go to the dollar menu or you can put that dollar in your pocket. You put that dollar in your pocket, you're saving it. You're saving it for later. Or you can put it in the bank account and start to earn interest off it. But then you got to pay this thing called taxes. Taxes is your taxes minus transfer payments. Taxes is what we pay to the government for operating the government. Okay, so how do we rewrite our savings when we introduce taxes, you might be asking? So savings becomes gross domestic product minus taxes minus consumer spending plus taxes minus government spending. That will give us our savings. For private savings, we take gross domestic product minus taxes minus consumer spending. That gives you your individual savings. Then we have this thing called public savings. Public savings is the tax revenue left over after the government's done with all its spending. Taxation minus government spending equals public savings. Little hint here, our government doesn't do that very well. In fact, they don't do that. In the United States, we have a deficit, not a savings. It's because our government is spending more than they have, which gives us the deficit. Otherwise, they would have a surplus. If your tax revenue is greater than your government spending, you have a public savings. Taxation minus government spending equals public savings. But in our case, in the United States government, we have a budget deficit. That is where our taxes minus our government savings, taxes minus our government spending is less than zero. It's negative, right? We have a deficit. So if it's positive, it's a surplus. If it's negative, it's a deficit. If gross domestic product equals $10 trillion, consumption is $6.5 trillion, government spends $2 trillion, we have a budget deficit of $300 billion. We just plug in the numbers, right? So gross domestic product, 10 trillion, consumer spending 6.5 trillion, government spending 2 trillion. We have a $300 billion deficit. Okay. So let's take a look. We got public savings minus 300 billion, taxes minus government spending. Our taxes would be 1.7 trillion. Private savings would be 1.8 trillion. Remember, it's gross domestic product minus taxes minus consumer spending. And then you take that minus your taxes and minus your consumption, 1.8 trillion. National savings, GDP minus spending, consumer spending minus government spending, 10 trillion minus 6.5 minus 2, 1.5 trillion savings. We have national savings of 1.5 trillion. It's just plugging in the numbers, right? Let's suppose the government cuts taxes. That's funny. By 200 billion. What happens? Consumer saves full proceeds of the tax cut. Consumer saves a fourth of it and spends the rest. The latter is probably true. The consumer would save the full 200 billion. The national savings would be unchanged. If they decide to spend it, then the national savings would fall by 150 billion because they're spending a three-fourths. They save a fourth, spend three-fourths. Which is more realistic? It's definitely number two. You're going to save some and spend a lot. When you save privately in your bank account, it's the income after your household expenses, after your consumption, and your taxes. It's your net. It's your net pay minus your net spending. That's your savings. Makes sense. What do you do with your savings? You buy bonds, stocks, you put it in the certificate of deposit, you leave it in your checking or savings account, you buy shares of mutual funds, you're investing. That's what you do with your savings. Because it grows with interest. I mean, that's the idea. You know, what you don't want money to just sit there. You want it to grow. When the supply and demand of the model of the system, loanable funds. How does a bank get money to loan you? Well, the bank gets the cash from other savers and through the federal system. And the loanable funds is what's the actual cash available in the bank to lend to you. The government system influences the savings rates. All savers deposit their savings into this market. The cash that you put into the bank, you think that cash is actually there? No, it's not. It's spent already. Or is it? Somebody else took out a loan. It's there virtually, but the actual cash is no longer there. That's what this tells us. Households with extra income can loan the money out and earn interest. Public savings adds to the national savings supply, and that cash can be then lent out. As it's lent out, of course, there'll be an interest rate associated with it. And of course, a higher interest rate is more attractive to those who are actually lending the money, not to those borrowing it. The demand for the loans comes from investments. Companies borrow the money that is needed to pay for new property, plant, and equipment. Households borrow money to purchase houses and other various concepts. The higher the slope of the demand curve as it corresponds with the interest rates, of course, there'll be more loanable funds with a lower interest rate. On the supply side, or at least where the supply and demand are in equilibrium, is, of course, where supply and demand equal. If you got 5% interest rate and $60 billion in loanable funds. Of course, there's some tax incentives, which will drop the interest rate, which will also increase the amount of loanable funds. There's investment incentives. Tax credits increase, but, of course, with a tax credit increase, there's a higher interest rate and more loanable funds. And, of course, there's going to be shifts in those supply and demand curves, just like there would be with anything else. The same as with the amount of capital available, the amount of cash that banks are willing and able to lend. And of course, those shifts can happen either way. So as we're analyzing these changes, we look at our budget. If there's an increase in budget deficit, there's less investment available. When the government borrows money to finance its deficit, which is what it's doing, it leaves less funds available for investment. We call that crowding out. That's the definition of crowding out. Investment is super important for long-term growth. That's why budget deficits reduce the economy growth rate for future standard of living. So to put it into context, right now our government here in the United States is essentially borrowing money, right, to fund infrastructure. Infrastructure is good because it promotes long-term growth in the economy. But it's also increasing the country's deficit, which is leading less opportunity for future investment. So it really is a difficult challenge. The U.S. government, notorious for borrowing money, runs persistent deficits, leading to rise in government debt. The government debt to GDP ratio tells us that the government's indebtedness relative to the ability to raise tax revenue is becoming increasingly alarming. This kind of shows you what the debt percentage has been in the past. During World War II, we were borrowing a lot, right? Because we had needed to make a lot of tanks and so forth and so on. The financial crisis, we needed to borrow a lot for growth in the economy to stabilize it. What will happen in the future? We're going to borrow some more for infrastructure. While on paper it looks great, well, actually it doesn't look great on paper. It looks good in concept. You know, I like the idea of our country investing for our infrastructure. I think that's important. But what I don't like is that we're borrowing too much too quickly. Because what we're doing is we're borrowing from our future. We're reducing our future borrowing power by doing it. So, just things to think about. Okay, any comments, questions, or concerns with respect to savings, investment, and the financial system? No, you're all good? Really? Okay, cool. I'm sorry, we went a few minutes overtime. But I sincerely appreciate all of you, as I always do. Okay, so to recap, we're in week 9. This Sunday night, you have 2 things you owe me. The Chapter 12 quiz, Chapter 13 homework. Just as before, it's like, 5 questions thereabouts on each one, nice and easy. Yeah. A couple of formula might be involved, so make sure you review the PowerPoint presentations that we just went over. Read your textbook, try some of the practice problems. Those are the ways that we learn, right? If you have any comments, questions, or concerns, you can always email me, call me, set up office hours with me. Remember, whatever it takes, I'm always going to be here for you. My job is to make sure that you learn and you do well. So if you ever need me, you can always get me. Right? Any questions, comments, concerns? Anything at all? You're all good? Okay. Thank you all so much for your time today. I appreciate all of you. Miss Meredith, did you have a question? You okay?
If you don't mind, so if I can ask you after class?
Sure, no problem.
Okay, thank you.
Of course. Thank you all so much for your time. Appreciate all of you. Please stay safe. Wash your hands. Do the right things. And I'll catch you all again next time. Ciao for now. Bye-bye.